Thank you all very much. Thank you, first of all, to Olivia and Natalie and Sarah and everyone else involved with setting this up. It's really an honor to be speaking here, and I greatly appreciate it. As Mike said, I've got a keynote presentation here, and I'm going to run through that, but please get your questions coming in. I'm not an investment analyst, but I've been writing about this stuff for a long time, and you know, we try to take a 30,000-foot view of what's going on in the markets, and specifically around sustainable investing with my beat on the Moral Money newsletter. So with that, I'm going to share my screen. There we go.
Brilliant.
Okay. So the topic at hand today, integrating sustainability into investment analytics, what the market is telling us. So first, I want to run through some ESG basics, and this may be sort of rudimentary for the people attending this. And if it is, I'll make it quick. But ESG, as we all should know at this point, stands for environmental, social, and governance. There are a few ways that ESG investing can be implemented. You know, the two classic ways really are positive and negative screens. Negative screens means cutting out bad companies. Think about, you know, some of the old socially responsible investing funds that cut out sin stocks, tobacco, alcohol, firearms, whatever may disagree with your, you know, personal sensibilities. Then we have positive screening, where fund managers, pensions, whoever it may be, investors will allocate specifically toward companies that they think are doing good on ESG. Divestment and engagement are two other topics you'll hear about a lot in the ESG world, especially around fossil fuels. Divestment means cutting those companies out of your portfolio. There are, you know, different theories of how divestment works. A lot of it's modeled on the divestment campaigns that were successful in the late 1980s around apartheid, and the idea being, you know, sort of creating a stigma around fossil fuel investing. The engagement side, which is what you'll hear from a lot of large institutional investors, pensions in particular, which I'll get to a little bit later, is around the idea of using your power as a shareholder to engage with fossil fuel companies and try to convince them to make the transition to clean energy or, you know, go green. But what ESG really boils down to, and this is kind of, you know, where it comes in, you know, with what the market is telling us. A lot of people out there may still think about old school SRI, socially responsible investing, where you're just investing according to your personal values, your religious values, whatever it may be. But ESG has come a long way in the past couple of decades. I remember when I was at a publication called Fundfire, which is owned by the Financial Times, which covers the institutional investment industry in the DB pension space very closely. You know, we started to see back in 2012, I want to say, investment consultants really pushing for investment managers to be considering ESG. And it's because, especially in terms of climate, but it goes across the spectrum, it's more about risk management than it is about expressing your values. So with climate, you know, there are two main types of risk that investors are worried about: transition risk and physical risk. Transition risk, meaning, is this company that I am invested in prepared for what is coming down the pike from regulators or from markets? So if they are selling fossil fuels and most of their valuation is tied up in these fossil fuel reserves that the Paris Accord has indicated will not be able to be burned, you know, there's a risk there that if those laws take shape as regular, you know, governments have said they will, that those assets will not be able to burn. And that's a major financial risk facing investors in those companies. Physical risk is, you know, looking at the actual physical assets of a company and how they may be exposed to the effects of climate change. Do they have factories in areas that are more flood prone than they would have been previously? You know, is there potential disruption for their workforces? Do they live in areas where they may be forced to leave because of climate change? You know, the idea of climate migration, stuff like that. There's also a lot of talk now about the risk analysis around issues like biodiversity, natural capital, how companies are thinking about, you know, water and other resources that don't really have a place on the balance sheet. But if they run out of those resources, it could be a big problem, you know, for the earth, obviously, but also for the bottom line. On the social side, it's a similar story. You know, you see investors considering risks of a social nature. Here I've written, labor strikes, consumer protests, risks down the supply chain. You think about a company like Boohoo, which is a UK-based fashion retailer, I believe online fashion retailer, who got into a lot of trouble because of what people found out was happening in their factories. And that was a social risk that ESG investors would have been trying to be alert to. And governance risks, the G in ESG is often overlooked, unfairly so, because it is one of the, it's as important as the other two, if not more so. It's all about internal controls, CE oversight, thinking about scandal avoidance, thinking about, do companies have the governance structures in place to avoid, massive blowups, like a company like Wirecard, something like that. So that's kind of the basics. When you think about it, though, the way investors are looking at it these days, that we've come to kind of throw them into three buckets. There's the change the world crowd, your impact investors, ones who want to use their money to make the world a better place. You see that a lot on the foundation endowment side, or foundation side, more so than on the pension side. Then you've got do no harm to the world, ones who want to make sure that they are not part of the problem in terms of climate or social ills or whatever it may be. And then I think the third group is the most important, and that's really where we've seen not all, but a lot of the growth coming in to ESG, is the do no harm to our portfolio. And that's, people that are trying to integrate these factors into their investment processes to avoid risk and maybe find alpha. So with that, we've seen explosive AUM growth. This is from US SIF. There are a lot of different data sources out there. One of the problems that we'll get into later is around data and how you classify an ESG investment. But US SIF estimates that in the US, the sustainable AUM has grown to $17 trillion. That represents 33% of the total US assets under professional management. So $1 out of every three, according to US SIF's estimations, is managed along some sort of ESG criteria. In pensions, we've seen this grow a lot on the DB side. You can see here, this is also from US SIF, the split out. They estimate the total AUM in institutional investments in the US managed according to ESG principles is somewhere around $6 trillion. And more than half of that comes from public pensions. They estimate a lot of that is looking at social and environmental, but you can really see on this slide on the right, or excuse me, the chart on the right, the breakdown of, they're looking across the board. So some examples of that, we've reported on quite a few of these. New York State pension divesting from fossil fuels. They've got a program in place where they're analyzing all of the fossil fuel holdings that they have and running through those and cutting out ones that they have determined are not going to be well positioned for transition to clean energy. CalPERS and Schroders calling for mandatory climate risk inclusion in company accounting. And then, CalSTRS, another one here, they're doing a lot. They just struck a big deal with BlackRock to roll out this new carbon aware ETF. I forget the exact title of it. But DC, the defined contribution market, is a entirely different story. And, DC, I think, safe to say, is the future of the US retirement market, the DB market. Obviously, you've got your large public pension funds, which aren't going anywhere, but the private DB market has been dwindling for years, and I don't think anyone would project a turnaround, a massive comeback in private corporate DB funds. So the money's coming into DC, from the private retirement money is coming into DC. But as of 2018, which was the most recent data I've seen, and I don't think it's changed much since then, only 2.8% of 401k plans offered an ESG fund on their menu. And there are a lot of reasons why. Well, not a lot of reasons. There's one big reason why, and that is, the guidance coming out of the Department of Labor around ERISA, which I'm sure anyone here is familiar with ERISA. But ERISA is the law that says, kind of sets the rules for what a retirement plan can and cannot do. And historically, it's been unclear how ESG is perceived under ERISA. Under Obama, they were more permissive. under Trump, there was a move for the end of his administration to clamp down on the inclusion of ESG. They ended up kind of watering down that final rule proposal, but the point is, across that administration, across the Obama administration, and now even still under Biden, it's murky. And investors or investment management companies are not going to jump in until there is clarity that these products can and will be used and that they won't get sued, basically. No one's, to my knowledge, it hasn't actually been tested in court whether or not ESG investments are permissible in ERISA plans. But no one is really willing to stick their head above the parapet, because the problem comes in that if you are putting ESG concerns above financial concerns, that would be a breach of fiduciary duty. You see in other jurisdictions in the UK, this is not as much of a problem. BlackRock just rolled out a big suite of target date funds or multi-asset funds that include ESG funds as their building blocks. But until there's more clarity around how exactly these will be handled by the regulators in the US, we're kind of stuck in a holding pattern. But the perception that kind of is holding this back is that ESG harms performance. But what we've seen over recent years, and there's a lot, I'm not a financial analyst, and there's a lot of debate about correlation, causation, and what the true driving factors are. But what we've seen, and this research came from BlackRock, is increasing evidence that ESG considerations are not detrimental to performance. And that lines up a lot with this new thinking about ESG as a risk management tool. You're avoiding these disasters. And theoretically, this is what Larry Fink has been arguing, as more investors catch on to this and think about this risk, that companies that are well prepared will, demand a premium. So this came from a paper, and there's links at the back of this presentation, which if I assume the presentation will be made available, you can click through and see all the sources and all this stuff. But what they found is that, sustainable indices outperform during downturns. The downside protection has been there, through 2020, through the COVID crisis, through the taper tantrum, it looks like the taper tantrum, and then the emerging market downturn of 2015. So there could be other reasons. I think in the COVID, there's arguments that ESG funds were heavily exposed to tech stocks and underexposed to energy stocks. Both sectors, tech did pretty well with everyone shopping from home and stuff like that, and working from home, and energy did not, because nobody was going anywhere. But anyway, the research is moving very, very much so in the direction that ESG is not detrimental to performance. But there's still problems, though, because what is ESG? I mentioned earlier that US CIF has made these estimates of what they think. $1 out of every $3 is invested along ESG guidelines. And frankly, that sounds really high. But part of the reason that it's so hard to pin this down is because it's really hard to say what is and is not a good company. And there are a lot of people out there who are trying to do that. You've got your MSCIs, your Sustainalytics, your Robeco Sams, you go down the list, and you've got all of these different companies that are offering up scores, ESG scores on company, rating them an A, rating them a F, whatever the scale might be. Just Capital does this, others. But there was a really good study out of MIT Sloan called Aggregate Confusion that looked at this. And you can see in this chart, what they found is that these ratings are all over the board. And they're really subjective. It's not like in the credit rating world, there's a lot, mass convergence, but among different raters on different companies. And that's because they're looking at a very similar set of criteria when they make that determination on a credit rating. But on ESG ratings, Tesla is the example that comes up all the time in this discussion, because some people will score Tesla very, very high because they are an electric car company and they are, popularizing the electric car, and moving away from the internal combustion engine is certainly something that would need to happen to stop climate change. Others, though, look at governance. They look at, the board and, sort of the power that Elon Musk has over the company. They look at some of the social issues, such as some of the things he said around the beginning of the pandemic, and they rate them poorly. And it's not to say, one rating is wrong, one rating is right. it all comes down to your perception. And, you know, you hear it from the people doing the ratings that they don't intend these to be, you know, sort of a end all be all. It's, they think of it more as like an analyst's report, you know, a buy or sell rating. But the problem is they're being used a lot in indices. There are a lot of indexes. When you look at passive investing, they're reliant on these ratings and being structured along those lines. So what you're starting to see because of that is people getting really hyper-focused on ESG disclosure metrics. And ESG disclosure metrics are boring, and I apologize. I will try not to bore you to death here, but there are so many of them out there. There's SASB, GRI, TCFD, you can read the list. And all of these different frameworks are important for how companies provide the information that investors need to know about their ESG risks. But there's such a divergence in so many different metrics that it's, you know, comes back to the problem on the last slide. It's so hard to tell one way or the other what you look at for what companies, what is material. You get companies, you know, this idea of survey fatigue where companies just get tired of filling out a million surveys. And then there's a problem that none of it's verified or audited. Not none of it, but most of it is, you know, contained in like a CSR report, a company sustainability report that is not audited, that is not, you know, provided with any level of assurance. So what we're starting to see now is a lot of movement to bring those together. And, you know, the theory being markets have sent this signal. We want this information. We need to know more about these types of risks, these types of opportunities and how they're affecting companies. But we don't have the data that we need in a way that makes it easy for us to compare one company to another. So you're starting to see with the IFRS developing what they're calling a sustainability standards board. The plan is, I believe, they're probably going to launch that around COP26 in November. COP26 is the big UN climate summit that I'm sure you're all aware of. And that's going to sort of bring together some of this alphabet soup. SASB, GRI, TCFD, CDP, IARC are all participate. They've kind of come together and put together a framework of how their metrics can be used as one, not as one. I'm oversimplifying it. It's gotten backing from the World Economic Forum and the IBC. They've been leading their own charge on this, led by Brian Moynihan of Bank of America, to try to come up with different ways of disclosure around the UN's Sustainable Development Goals. But the IFRS is kind of bringing all of this together through the Sustainability Standards Board. And there's a lot of hope, I think, pinned on that as a way to normalize this data. You've also got efforts at the EU level around the non-financial disclosure, non-financial reporting directive, excuse me. And for investment managers, there is the other one, the SFDR, the Sustainable Finance Disclosure Regime. I don't know, something like that. I'm blanking on the actual terminology. It's all kind of runs together after a while. But the point is, it's moving in that direction. You're going to start seeing mandatory climate disclosures. You know, New Zealand has already said companies will need to report to the TCFD, which is the Task Force for Climate-Related Financial Disclosures. The UK has indicated they're moving in that direction, and that may be happening in the US. Larry Fink, again, I keep talking about him, keep talking about BlackRock, but they are the 800-pound gorilla in the room as the world's largest asset manager. He said in his letter to shareholders that he wants to see mandatory disclosures on climate risk in particular. Since Biden has taken office, we've seen the SEC, the CFTC, and the DOL really turning over a new leaf. The DOL came in and immediately said that they would not enforce that guidance or the rules, excuse me, that were enacted at the end of the Trump administration on ERISA and ESG. And at the SEC, it's really interesting to watch what's happening there, because we saw John Coates say that they're going to start paying a lot closer attention to documents coming out of companies that may be materially misrepresenting climate risk. That would include CSR reports. That would include, you know, stuff other than 10Ks and other things that the SEC would normally look at. The Federal Reserve has joined the Network for Greening the Financial System. So all things are kind of moving in this direction. But what I expect, you know, in the future, and what I think a lot of people are hoping for, is that there is a bit more coalescence. There's a bit more standardization of the data that companies are required to report, because investors, whether it's asset managers, pensions, foundations, endowments, retail, you name it, they've really latched on to this idea that ESG risk is material, that ESG matters, and that it's not just the old way of thinking about investing alongside your values. It's a way of thinking about what a company is worth being tied to these risk factors. So with that, I will come back to Michael, and we can get on to questions.
The question that did come in is a very interesting one from Jeff Leiter, and it's about Albert Hirschman's 1970 book about exit, voice, and loyalty. It was a book, Exit, Voice, and Loyalty, Responses to Decline in Firms, Organizations, and States. And at the time, there was some concern. I think it was a Nigerian railway, why it was so poorly run, and all the people that could have advised it to do better had left. They'd exited, and so there's a interesting distinction here between divestment and engagement, which sort of parallels what Hirschman wrote about between exit and voice. And Jeff's question was, does Hirschman's analysis give any leverage for the investor looking at ESG? If yes, does the loyalty concept in Hirschman provide any further leverage? The fact that pension funds are avoiding and leaving some of the big polluting firms, or the firms creating a lot of carbon, and they're looked at as good in that respect, may, given this lens, may actually not be so good. Well, but so I just like your response to that.
Yeah, no, absolutely. I think that's a really good point. And I think if you look at some of the divestment plans being launched, the one in New York in particular, Tom DiNapoli's plan as New York State Comptroller with the New York Common Retirement Fund, they're being done in a very thoughtful way that I think gives a lot of consideration to this type of issue. You know, you've got your hard divestment advocates, right? You've got, Bill McKibben, 350.org, with the whole bus tour going around to universities and saying, get out of fossil fuels. And I mean, I'm not saying that they're wrong. I'm not saying that there's not something to the idea that, if these kids want to have a world to grow up in, then the university should not be investing their money in a way that's going to destroy that world. But when you look at someone like Tom DiNapoli and what he's doing in New York, it's a very thoughtful divestment process where they're going through these rigorous reviews of their portfolio. And they're going sector by sector. They started with thermal coal. They've now done tar sands. And what they've done is go to all of these companies, and they're really using divestment as a last resort. And even the most hardcore engagement advocates have said similar things, that they will engage until they can't. But it's not about, it's not like a cut and run for a lot of these investors. And I think that there is a lot of that, the concept of loyalty being dedicated shareholders who are trying to work with these companies. Because if you're a company, I'm sure some of them have their heads in the sand or are climate deniers or are, not interested in making the transition. But if you are a major fossil fuel company that is looking at the future landscape, you have to see the writing on the wall that things are changing. And having loyal investors stick with you and help you along the way, I think I can see how it would be beneficial. Obviously there are others that are tigers maybe not changing their stripes, and you're starting to see some of these investors that get a bit more serious. In the FT, if you've been reading about the board battle going on at Exxon, would be an example of that. But yeah, I think there is something to the idea of loyalty and kind of helping as, major shareholders shepherd these companies along the way.
So Brett Hammond, we have now plenty of questions. Brett Hammond asked, what are the implications if there were to be complete convergence on disclosure, reporting standards, et cetera? What would be gained? What lost? Who would win? Who would lose? And I guess I'd add to that, right now there's a lot of diversity in terms of standards. Does it make sense there'd be 2 standards, 3 standards, 4 standards? If you could set things up, how would it work? Would there be just 1 standard or 2 or 3 main standards?
No, it's a really good question. I mean, I think that if we come to one global standard, a lot of people are going to be left wanting. I mean, I think that it's probably a safe bet. You know, this comes back to that issue of materiality, right? And materiality sort of being in the eye of the beholder in many of these cases where companies get very frustrated being asked to provide information on things that they don't have data on because they don't think it's relevant. But then investors saying, no, this is relevant. We need to know this because it matters to us. And there's going to be conflicts there. So I mean, I think that any sort of global standard will be broad, and it will be maybe not as onerous as what some investors might want. You know, right now what you're seeing is investors having to fill the gaps, having to go to these, you know, third-party data providers that are sourcing data from wherever they can. And you know, it's pretty, they get pretty in-depth, but it is, you know, very much, there's a lot of guesswork in there, basically. So anything that can kind of close that gap and make it so that I think what's really important is that we can trust the companies when they are reporting this data, and then it's reported in a way that doesn't allow them to sort of tell the story they want to tell, but provides more objective information. But I don't know. I mean, I think that even if there is a global standard, it will be a global minimum, and you will see ESG investors push for more. Especially, you know, there's a split between SASB and GRI that kind of illustrates this. SASB is all about materiality. It's all about financial materiality. It's the Sustainable Accounting Standards Board. GRI kind of spans a much broader scope of information that they want. And I think that SASB and GRI are not going away if, you know, the IFRS achieves what it sets out to achieve and the US signs on to that. I mean, there's no guarantee the US would sign on to that, but SASB and GRI would still be there. And if there will be investors that want a full, you know, GRI report from companies, and I think that you'll still see that. It just won't be quite as scattershot as it is now.
That's great. Now, there have been a number of questions that have come in on DC, and I want to try to combine them, or at least let you deal with them all at once. I was struck by the statistic you talked about that in the United States, only less than 3% offered 401k options. And so there were a couple of them. Rachel Mann asked, do you think DC plans are just going to wait until they get a more clear pro-ESG rollout of DOL, even as there is increased consumer employee pressure to offer ESG in a 401k plan lineup? Do you think that 401k plans will incur the cost of lawyering up front in order to feel confident they aren't increasing litigation risk? Yesterday, there were some comments about the costs of all this too. And we'll jump into an ESG option without additional guidance from the DOL beyond the current non-enforcement policy of the anti-ESG rule. Then Cynthia Mallett asked, the universal owner concept clearly applies to a DB investor in ESG with a clear long-term interest, but has no clear analog in a 401k plan lineup. Do you think that any sorry,
it moved over to the answered tab.
It went over to the answered.
Went over to answered.
So
it moved over there.
It went over to answered and has no clear analog in a DC plan where individuals arguably have divergent long and short-term interests, at least as long as the overhang of the participant direction versus sponsor direction persists. To what extent is this a contributor to the large gap in DC adoption of ESG funds, either standalone or within a QDIA? And then there was something that came in on chat from Surya Kalori, who asked, how can we reconcile the fact that survey after survey shows that investors want to invest along ESG lines, yet if we look at the actual data in these type of investments, especially in DC plans, there's hardly an uptake. How can we explain this lack of investing momentum at scale? So, I mean, there's a question of how much of it has to do with legal constraints.
Yeah.
How much of it has to do with lack of innovation? I mean, so the fact that individuals have much different preferences on ESG, and you know, how can you actually capture that in a fund and at a cost-effective way? And I guess I'd also ask, where do you think things will go in the next 5-10 years in this area? How much progress do you expect?
So there's a lot of questions there, and I'll try to get to all of them. I mean, I think the question about lawyering up, I'm trying to pull these up on my screen to make sure I remember exactly what was in there. But yeah, are DC plans going to wait until they get more clear ESG rules? I think DC plans are going to wait until they get more clear guidance from their advisors and from investment managers. And I think investment managers and investment advisors are going to wait until they get more clear guidance from the DOL, or until there is some sort of settled, case law that would indicate the thing. And I know for a fact there are some, activist investor groups that are looking at, finding companies, finding plan sponsors, 401k plan sponsors that will add these funds with the intention of getting sued, to try to just get this tried and done. Their theory is they will win and it will open the floodgates. I've spoken to a lot of fund managers who say that they would love to roll these products out. I mean, I think we all know fund managers are desperate for fees in any way, shape, or form they can get them. If they can add, an ESG layer onto a fund and charge more for it, and outperform, they're certainly want to do that. But what that will take to get them into the funds, and I think this, one of the other questions is about uptake. And I think it's hard to judge uptake of ESG options in 401k plans when there are only 2.8% of them are even offering them. The uptake comes at the stage, the uptake as it is now is constrained at the plan sponsor level, the plan advisor level, by not even putting these funds onto the menu. So judging what the actual end investors want is difficult when the option is not being made available. And I think there's a lot of lack of education among individual plan participants around how these things even work. And I think there's a lot of healthy skepticism as well from end investors about what are they actually getting out of this fund. I mean, you look at the holdings of some of these funds that are branded ESG or carbon free. I did a story on ESGV, an ETF that said it was fossil free and had like 10 different fossil fuel companies in it. And then it's like, oh no, we didn't mean fossil free. We meant no fossil fuel reserves. These, Marathon and Anadarko and these other ones, that doesn't count. It's like, well, I think when people see that, they're just getting cynical and they think that it's all just a load of marketing BS. But yeah, so the uptake question, it's a good question. And I don't know. I think that if there is a case, coming into the universal owner point of view, obviously, the idea of universal owner as GPIF or CalPERS sees it makes a lot of sense as far as why they are thinking about these big picture long-term risk factors. But I think if the data bears out that ESG can provide downside protection, that ESG can outperform or at least not harm performance, I don't know, that it is necessarily divergent from investor interest. I guess it depends on where you are along your retirement glide path. Maybe it makes more sense for you to think short term if you're closer to retirement and you're about to move it all into some sort of liability matching scheme or the equivalent thereof for an individual. But I don't know that I don't know. It's a good question. I don't know that I have a great answer for it, but I think that performance concerns, if the data continues the way it is, I don't see underperformance as a reason to avoid ESG at this point.
That's fantastic. So we have one last question from Emily Kessler. It has to do with hedge funds. And I guess I could read it, at least part of it. Has there been any thought about how, particularly for these emerging green technologies that they're now beyond R&D and beta tests, moving into shovel-ready stage, to create investments for common folks who can't take the risks of hedge funds, and more critically for institutional investors, structuring bonds and other investments more friendly to the cash flow needs of pensions and insurance companies? It would take a convergence of rating agencies and institutional investors to create the appropriate investments. So, I mean, the role of hedge funds in creating, thinking about what role they play in this, and I guess also there's this issue about what role pension funds can do in encouraging more innovation, because a lot of what's required is not necessarily big in terms of investments, but actually seed funds, and maybe the big pension funds aren't interested in it. We have about 4 minutes left, so this will be the last.
I think I can do that in 4 minutes. It's a really good question, and it's a really important question that we need to find an answer to, right? Because you've got to think about. I mean, you hear it from Bill Gates, you hear it from Jeremy Grantham. We need new technology to help us in this fight, whether it's carbon capture and storage, or whether it's new clean energy, new battery technology, new ways to electrify and electrify everything and then make the grid green. There's a lot of demand for that. On the public pension side, this is a massive problem, right? Because these public pensions, the large ones, they're not writing tickets that are lower than $100 million. So a lot of these early stage venture funds, or, even regular venture funds that are out there pursuing these new technologies, $100 million is way more than, it's more than a lot of these entire funds. It certainly, doesn't meet the threshold that a lot of these institutional investors have about not being more than half of the fund or more than 10%, or it depends on their IPS. But there is a problem with mobilizing these pools of capital into these smaller early stage opportunities. Hedge funds can do it. You're seeing it in private equity. You're starting to see, more fund to funds type models come about that are dedicated to getting money to these smaller managers into these smaller companies. A lot of people trying to not call them fund to funds because fund to funds kind of have a bad reputation about the fees. And then there's a lot of companies like Michael's company, Willis Towers Watson, on the consulting side, who are doing these quote unquote emerging managers programs where they are, kind of facilitating this ability for large institutions to allocate to more, smaller opportunities, smaller investors. But I don't think that the solution I don't think that there's been no magic bullet found yet. And there is a lot of need for that type of money. I think there's a direct corollary on the other side with the common folks. And I know I'm running short on time, but you start to see it through crowdfunding, you start to see all these other opportunities, but it's so hard to vet what is and isn't a good actual investment. There's a lot of scams out there, frankly. And it can be dangerous for the retail dollar. Look at what's going on in the SPAC market right now, and all of the shorts that are attacking some of those companies. So yeah, big problem. I wish I had the answer. I don't know that anybody does, unfortunately.
That's great. We're actually perfect in terms of time. So thank you very much. That was very interesting. And thank you everyone who submitted questions. They were very, very interesting questions and very interesting answers as well.
Really good questions. Really, really good questions. Very thorough. I'm super impressed. Thank you guys.
And I just want to remind everyone to take a look at the Twitter feed and the website, FT website, and take a look at the Moral Money newsletter.
Absolutely. ft.com/moral money. You can sign up for the newsletter there. I think you can get a 30-day free trial to the FT while you're there if you're not already a subscriber.